The first half of this year is about as fast as stock markets ever decline. I remember seeing that the first 4 months was the fastest decline in the S&P since 1939, when I was 1 year old and they were preparing for World War I. So that's a pretty good excuse to go down. And this was the fastest decline. This is about as fast as markets go down. They always have good rallies. There's nothing as quick and spectacular as a bear market rally. They had one in late 1929 to early 1930, an absolute doozy of 45%. And of course, with historical hindsight, they signify very little, but at the time, they frighten the pants off the bears. And they give hope that all is over, all is forgotten, and it's back to the races. And I suspect we may very well have a pretty decent bear market rally as we sit. I wouldn't be surprised if this went on for at least another month. In terms of the entire bear market, it would be unusual for it to bottom out anywhere near this high. I would expect that by the low, that the S&P would have declined by 50% from the peak in real terms. So you do have to adjust the stock market for inflation. And also the trend. The trend in the market is a little over 4% a year. And as time passes, you should put that into the fair value. So a year from now, when the bear market might end, trendline value would be almost 3,000 on the S&P. Of course, there's no rule that says you stop at fair value. Typically, in previous big bubbles breaking, they go down below that. They went down below, of course, in the housing bust of '09. And they went down in every great bear market break, they went below trend, except Alan Greenspan's specialty in 2000. In 2000, the S&P was heroically overpriced. It came down 50%. But at 50% decline, it was only fair value. It only hit the trend and then bounced as the Fed raced to re-stimulate. The NASDAQ went down 82. That's a lot of pain. And it's possible that would do that again. But you do have to adjust for inflation. There was very little inflation around in 2000. But this time, with inflation running at 8 or 9, it does move the nominal value of the S&P upwards, and one shouldn't lose sight of that. The second shoe is going to drop, which is profits. So you have even a mild recession, you get a big whack from profit margins. And the PE goes down, but also the earnings, you're multiplying it, goes down. It is quite likely and plausible that earnings will drop in a recession. I don't include classic FANGs as being in the super speculative category. I think you could throw Tesla in at its peak. That was super speculative, great company, but a bit of a silly price there. But the others, like Amazon and so on, they're great companies, but I wouldn't have included them as super specs. And yes, they're down quite a lot. It's hard in a bull market to get your brain around what happens in a bear market. Let me go back to Amazon in the 2000 bust. It didn't just come down. As its sales continued to grow, of course, in those days, it didn't have earnings because it was running on borrowed resources. It didn't have to. It was still growing like the wheat. It came down 92%, 92%, with strongly rising sales. A brilliant, successful new idea that went on to own the world and be worth a fortune. How is it possible it came down 90%, 92? Think about that sometimes as you go to bed. I like to say 80% of the time the market is pretty sensible and doing a possibly good job of estimating value for all the companies. A little under 15% of the time, it gets carried away with optimism. And by the end of that time, has nothing to do with actual earnings. It's all in the head, projecting out hundreds of years into the future, assuming that perfect conditions will stay perfect forever. Every bubble takes place with near perfect conditions and huge profit margins. And the market runs with that and assumes it will stay there forever. And of course, conditions mean revert, profit margins mean revert, and good times become bad times. And that is a problem. And the remaining 5%, the market gets carried away on the downside and starts to be completely irrational, as it was beginning to be in March of 2009. It was getting pretty silly, pessimistic. I wrote a piece, Reinvesting When Terrified, that by sheer luck came out the day the market hit its low. And it said, get a policy, get a plan, present it to your committee or yourself, and start to throw your money back into the market. You feel paralyzed, everyone always does, and now's the time to wake up, the market is cheap. And of course that happened in 1974 and 82, which were classic lows, and the market got down to 7 PE. And what I call terminal paralysis sets in, where you're so frightened, you can hardly move, you can hardly get to work, forget buy stocks. And that's, of course, as Warren Buffett would have said, that's exactly the time you have to do it. And it's only 5% of the time. They're much quicker than the crazy bull markets. If I'd been asked to bet, would the Fed get inflation wrong when inflation came along at any time, I would have said, of course, they'll miss it, they'll be late, their responses will be pretty ill-judged. The Fed's record is terrible. What is impressive is how much room they have been cut by the market. I mean, the market is incredibly forgiving to the Fed. The Fed happened for 20 years, 25 years, to benefit from that amazing era as 500 million Chinese raced into the big cities and were plugged from marginal farming into highly profitable industrial system. And then they joined the World Trade Association and made everybody's stuffed dogs and everybody's iPhones for that matter. During that phase, 500 million extra Chinese, 200 million Eastern Europeans plugging into away from communism into capitalism. That was a golden era, Goldilocks, if ever there was one. And the Fed got to take credit for that. It's done nothing in terms of increasing the growth rate, but superficially, it felt like a golden age because asset prices went up, because inflation came down and rates were allowed to come down. And in the end, rates were forced down. And low rates make leverage cheap, make private equity deals wonderfully easy and profitable, and they push up the price of real estate and they push up the price of stocks. And that's the way it was. And this time, if you adjust for the passage of time, the price of oil is not as high, but it's still multiplied recently by 3 times. So that is imposing pain on consumption and is imposing inflationary pressure. We also have, because of the invasion of Ukraine, we have had some extra spikes in the price of food, fertilizer, and natural gas, particularly in Europe. Interestingly, they are now, almost all of them, lower in price than the day before the invasion. And this is a lovely example of how the stock market works. The stock market is saying, whoops, there's so much damage from commodity price rises, et cetera, we're going to have a recession. But the recession isn't bad news because the recession is going to get the Fed back in our camp of lowering interest rates again and helping stock prices. And we're looking out into the future. And therefore, that's a good news. So the fear of a recession becomes a wishful thinking about future interest rates. And so the market gets a reprieve for a while. It's quite remarkable, but it's fairly typical. And that's what we're having now. And that's why we might have a bit of a rally for a few weeks. I think in the longer term, forget the next few quarters, who knows what happens really. But in the longer term, we are really running the risk that this is back to the 70s. We have problems with the availability of plentiful, cheap resources, and we have problems with plentiful, cheap labor. The birth rate has crunched in every developed country except Israel and China. That's a very, very important segment of the global economy, to say the least. And every one of them has lower than replacement level. So in the end, after accumulating lots of older people as a higher and higher percentage, we start to actually have the population drop. Secondly, we're 10 and 20 years in, depending on the country, into having smaller baby cohorts. So we know with absolute certainty, since they're alive already, the 20-year-olds arriving in the marketplace will be fewer and fewer for the next 20 years. And we have not experienced this before. This has happened incredibly fast. China has gone from plenty of babies to a baby crunch almost overnight. Their fertility rate that needs to be 2.1 is probably running about 1.4. And even in the US, the UK, we're running about 1.7. We've never seen levels like this. So we're going to have a hard time getting enough labor. We're going to accumulate old people who are very resource intensive. They need a lot of medical care. They need a lot of people care. And we're not going to have all that many people there. The supply of people to look after us old fogies is dropping steadily from now on for the rest of your life, for sure. And at the same time, I believe the correct interpretation of the commodity data is that it wasn't only China shock, the rapid growth rate for 30 years in China, but it was also showing signs that the best and cheapest, most plentiful resources had simply been mined or pumped, and that we are running down into the second tier. If you look at the trend has been pretty remorselessly up since 2002, and my guess is it will continue to rise. And that will pose a real stagflationary pressure for a couple of decades. And that's why I fear this is re-entering the 70s and 80s, if you prefer it, re-entering the 20th century once again. So inflation will always be part of the discussion. Sometimes it will be low, sometimes it will be higher, but it will always be on the agenda. The same with stagflation. There will be pressure on growth that we have not had. We have had a glorious honeymoon period for 20 years where rates always came down and where Chinese workers were always available and inflation was a thing of the past, and it is no longer a thing of the past. And unless we're lucky and have some sensible behavior from governments around the world, this inflation will go in little waves and will become moderately embedded at best and really embedded at worst. The risks of destabilizing the whole global system have risen and continue to rise. It is quite scary. The risks are in the developed world too. But the speed with which Sri Lanka went from jogging along okay to complete chaos, I mean, that is shocking, isn't it? The whole system, it took less than 2 years to go from, to an outsider anyway, looking pretty stable to looking out of control. It doesn't take much. And when you mess with food, the Tahrir Square days of the Arab Spring, they chanted bread, freedom, dignity, bread, freedom, dignity. But bread was first. And that was just based on a temporary 150% increase in the price of wheat. Well, we just had another one that was 150% increase in the price of wheat. And there's likely to be pretty powerful repercussions around the whole of Africa, the Middle East, and who knows where. The thing about these pressure points is it's often unexpected, like Sri Lanka. Things you didn't have on your radar screen suddenly blow up. Bad things can happen anywhere. In the US, you'd have to say our democracy looks to be in the worst shape for 80, 100 years or more through my eyes, with attempts to overthrow democracy as far as one can tell. It's dangerous times without a war. And ironically, the war may improve some things, but it certainly increases the aggregate risk of some terrible mistake being made. In the end, resources will become more important. As I like to say, it doesn't take much for the 4 loaves of bread for a haircut to become 4 haircuts for a loaf of bread. In the end, a loaf of bread is more important than a haircut. And they have a lot of the world's resources out there in the emerging world. Maybe that will turn out to be a trump card. We still haven't reached the utilization rate. The percentage of people working is way down from 2000. In 2000, we had about as high a participation rate as anyone on the planet. And since then, ours has come down. The Italians and so on have gone up. We have one of the lower participation rates, which is really the definition of unemployment. How many people do you have? What fraction are working? And the rest are, in a sense, unemployed. And we do not equal the EU. The way we state the unemployment rate, we're always very proud. But we have more people not working than Europe does. They seem to have found a new willingness to resign if the job is crummy and they're not paid enough. And they have been treated diabolically badly since about 1975. And they get paid a ton more money than they used to, and we do not.